Hello, everyone. Welcome to today's session. Let's get underway here. Market conditions doing quite well here the last few days. We're seeing a little bit of a pullback today. We'll talk about the big picture as well as some of the current shorter term trends that we're seeing. Big picture still sitting at in a bull market, bullish in a bull market, essentially, which means that our short-term trend is moving higher as well as the long-term trend is moving higher. And our momentum indicator, this 1-year momentum indicator, we are at the extreme end of that trend. So we can see that on the chart here as well. S&P 500 going back the last couple of years as we've been in this overall uptrend. We're at the top end of that range versus in the middle or counter trending or running into resistance. And we also see that with the momentum indicator where we're sitting right in this upper level of 26 and a half, and that is certainly elevated for sure. But it can stay there for a length of time. We talk continually about how to manage a trend at the upper end of the trend range as far as risk, because we can, when markets reverse, they can reverse pretty quickly, and oftentimes they will sell off much faster than they go higher. So when we see these markets just kind of clogging along and chugging along and moving higher, and sometimes they take weeks or months to go up and back and up and back. And then within a day or two or three, we just get this massive selling and it just wipes all that out. It can happen really quickly. So we want to make sure we are positioned for risk on the way up and into those trends as well, and understanding where we're at in those trends. So this is really that big picture. It moves very slowly. This upper line is 1 year versus 20 years. So it's going to move a little bit faster, but really the last year, you can see we've just been working on this overall uptrend with some pullback. Really, since springtime, we've been relatively flat in terms of momentum. Even though S&P has been moving higher, it's been hasn't been really broad based. If we come in and look at some of the shorter term indicators here, momentum now starting to work its way back up into that extreme range. Not quite extreme yet, but we are up at the upper end of the range. So when we're talking about upper end of ranges and lower end of ranges, obviously you can see what it looks like in terms of about where we can potentially start to top out in this trend, and we're in that area currently. It can certainly get one more, a big spike and push it up into that, but it typically doesn't last very long, a day or two or three, maybe when we're up in those extreme areas. Brett also working on the upper end of the range, working towards that extreme range, and that's helping this market move higher significantly. Sentiment has been one of the ones that's been a little bit weaker. We've talked about this divergence where we have price activity moving higher and the indicator moving lower. That does represent more than likely some internal, larger institutional selling. As I've mentioned before, there is a component of the VIX in here, which you get some put buying by larger institutions can drive the VIX higher, and that is really an institutional type sentiment indicator to where you're getting. It is also called, the fear indicator, because of that, how it's built. It's built on that extrinsic value and on put options. So we can see that getting a little bit weak right here. We know we're at the upper end of the trend. We know that trends don't go straight up. We know they don't go straight down, but we do know that when they do go straight up, they're going to correct or counter trend or revert to the mean, essentially. That's not a very good line, but when we have this uptrend and we're talking about a chart, particularly on a market or S&P 500 or a stock in general, we want to see a chart that looks like that overall. But along the way, we get these big moves up, maybe a pullback, maybe a big move up, and then maybe a little test, and then maybe a breakdown, and then maybe it comes back up, and then maybe it moves higher. But ultimately, that trend starts to work this way. We just get a lot of peaks and troughs along the way, and that's pretty normal for market conditions to do that. So when we're at the upper end of these ranges, we don't want to believe that it's different this time, that it's always going to move higher. That's just not reality. And we also want to be aware of what's happening economically. We've been talking about the bond yield curve. We've seen a lot of activity here recently in the short term. In fact, let's jump over and look at that on these bonds. We're seeing bonds selling off significantly, finally getting a little move here today. And remember, when bonds are moving down, that means interest rates are moving higher. So we still have a situation where the Federal Reserve is not done. They they may not be able to be done. They may have to have rates higher. The bond market is anticipating that now, just based on some of the economic numbers uh, and and some of the inflation numbers that have come out over the last few weeks. We've seen a pretty significant sell-off in bonds, both the short-term and the long-term bond right here. So it'll be interesting to see how that pans out over the next few weeks as well. S&P 500 making that big breakout, a bit of a retracement today, 0.5%, nothing too extravagant, at least as of now. And we've got several support areas that if we do break through those support areas, those will be areas of note. And then we've also got a real major one right here on S&P 500, all the way back down at 563, 564 on SPY. And again, just as a reminder, most of the charts and analysis that we look at, in fact, all of them are ETFs, are exchange traded funds, and this is on purpose. Part of this is so that you can trade those. Okay, if we're looking at the S&P 500 index, then you could go out and trade the index if you're trading futures or things like that. But as far as just a very easy way to add into a portfolio or buy a market or buy an index, then ETFs are definitely the way to go. And SPY is really the granddaddy of all of those ETFs. I guess I could say triple Qs are right there close by. Tech's having a decent little sell off here today, 1.5%. Solid bar, but again, we're in that range where we can have a certain allowable range of volatility, and retracement down not so much today, 0.45, and so we're seeing a little bit of pause over the last 3 or 4 days where we've had some nice upside. Buy-sell ratio slightly bullish here as well at 1.66. Bulls in control, at least on that buy-sell ratio, and that is, again, just giving us a slight undertone to bullishness. We're seeing sectors which are also relatively flat. We did have a couple that were in that sell range, and they've moved back up, but either back into that hold range or back into that buy range. So the underlying factors of the market, and kind of those internal factors where we're looking at the market as a whole, and then we're looking at some of the components such as the sectors, as well as the breadth of the market, the amount of companies that are participating in these trends. If we jump in and look at commodities, we're still seeing a pretty decent commodity run here, and we've been talking about gold, silver, been talking about USO, which is oil, and we've also been talking about copper here as well, just because it's in this move and starting to have some strength, pulling back significantly over the last day or two. Gold, GLD up slightly, again, all-time highs here on gold, and still continuing that overall move higher. SLV, which is silver, also continuing to work towards that upper momentum zone. And then USO, which has just been got beat up pretty hard overnight and back into some of these support areas. It was trying to get some momentum here and just couldn't quite get there. So it's a little bit more work to do for USO to get back up into that upper range in trend. If we go through and talk about, again, so in terms of market condition, those are our overall market conditions. When we're basing individual trades or we're basing portfolio allocation, one of the approaches is to say, where are we at in the trend and how aggressive do I want to be in that trend in terms of allocation or percentage towards equities? Do I want 100% of my allocated money for equities in equities, or do I want a certain percentage of that? And we've kind of settled in to we're about 25% currently, and holding that range. A little bit higher than 25%, getting a little bit more volatility in there today, but getting a few that have been working pretty nicely. We had a big nice run in. We closed it out the other day. It was LBPH, longboard LBPH. Had a buyout offer, so it gapped up 50%, and we have those buyouts. Typically, the price will stop moving from there because the buyout institution is saying, "Hey, we're going to buy this stock for $59 or $60 or whatever it is per share." Obviously, it doesn't make any sense for that stock to trade anywhere above or below that because that's the buyout offer. Now, the stock will continue to stay active until that merger takes place, but this chart will just show up as flatlining. So if you ever see a chart that just has these little ticks like this, more than likely it's still listed, hasn't been converted over to the new company yet, and is just getting those real small ticks like that. That one, we were able to close that one out yesterday. Sometimes you just get lucky and you get some stocks that are trending higher, especially some of these biotech names. They do get bought out, or they get an FDA approval, or they get some trial that they've completed that looks amazing, and you just get these real big runs. And that can work to the downside as well, where you get a gap lower because they didn't get the FDA approval, or they had some kind of a lawsuit, or they had some kind of a recall, or things like that can happen in stocks. And that's one of the reasons why we want to make sure that we're maintaining our certain allocation and our percentage size. So in this case, we're sitting a large percentage in cash and about that 25 to 30% in position sizes. Now, again, this is called a wheel methodology, where we're adding into new positions. So we have the new buy list or whatever scan we're using, and when market conditions are continually moving higher, we're adding into stocks that are moving higher, and doing that daily. Okay, so we're adding into stocks that have some of these nice price patterns to the upside, and ideally we're getting higher volume and we're getting up into that momentum zone, and then we're adding 2 to 2.5% into the portfolio. And then we set a stop loss on that, so we're able to manage. Now, remember, the thesis of the overall methodology is that great stocks grow, and great stocks grow quickly, and great stocks make money. Okay, so you've got to have some green in here. You've got to have some earnings. You've got to have some quarterly EPS growth, some sales growth. And when that's happening, and it's happening on growing stocks, we can get some of these big runs, 5, 6, 7, 8, in this case up to 20 in this run. Then a whole lot of chop right here. At some point, you're going to get this market equilibrium that where you have market participants that are like, holy cow, I don't think so. That's not even close to reality. There's no way in the world that these guys could do X, Y, Z. And then you get the bearish side that starts to come back in. So it's the stock market, I've mentioned this before, it's just a giant auction, and there's buyers and sellers, and that's it. Okay. Yes, you have investors, but they're buying and selling also along the way. They just may not be doing it very often. But I guarantee you that these larger institutions, when they're adding in positions, they're adding in continually during that trend, and they're helping push that trend higher as well. So we're looking for these kind of stocks that are moving from the lower left position of the chart down here to the upper right. Now, what we're ideally, a 2020 hindsight is fantastic, where we can look back and say, oh man, I should have bought it here, and I should have bought it here, and I should have sold it here. And it just doesn't work that way. Okay. So when we're looking at a chart, sometimes that can create some false bias to where we think that this is a high level and this is a low level. Okay. And that's where we should have been buying here, and we should have been selling here. And we say, I've missed the move. Well, stocks don't work that way either, because when these companies grow and the earnings are growing, we can see thousands, if not tens of thousands of percent increase in a company's earnings. If it's a new idea and a new company and new growth, then they can keep growing. And that ultimately is the point of owning a momentum style stock or company in general. If you buy something, you buy a stock, you expect it to go higher, right? And in this case, the fuel to run it higher is sales and earnings. Okay, so you get companies that there's also or the anticipation of sales and earnings. So if you have a new company that's moving higher, I just happened to pull this one in here because of this chart, and it is a newer technology where it allows, I believe it's based on web browsing for the blind, and has some technology to allow for disabled to participate in online activities in a functional way. And so whether they're earning money or not, they're probably earning some volume super light. There's risk in those kind of names, but if we were to look at Meta, for example, parent company of Facebook, from 300 to 600. So this stock has gone from 300 to 600, it's gone up 100% in the last year. Now, these are massive numbers. as well, but they're still growing and they're still growing. And where did they start out 20 years ago? $7, $8, and they just keep going and going and going. So the idea that companies can continue to grow higher and go and move higher is ultimately what we're looking for. Now, we're not as concerned about buying, we bought the exact low. That just doesn't happen very often. Okay, now if you're a longer term investor, you're riding these out. And with the same expectation is, I believe in Meta, I believe in Google, I believe in Apple, I believe in Tesla, whatever it is, and the fact that you believe in it is great, but you also have to realize that the company has to continue to perform. And if it is, and if it does, and you own the name like a Netflix or a Meta in this example, that you can certainly, as it's moving higher, add into positions as it's moving higher. Now, we're focused on a trade, and a trade is simply where we're buying at a certain point and we're selling at a certain point. And we can do that with the same stock over and over, okay, even if it's Meta or if whatever that is, because at some point, investors, traders are going to say, man, these guys are priced to perfection. And if they come out with an earnings report and it doesn't quite get there, you can get these gaps and you can get these trends that start to shift back down again. Doesn't mean the company's going bankrupt. Doesn't mean they're going out of business. Doesn't mean really much other than the fact that just what I talked about, the trends can move like this. They typically do. And so what we want to try and focus on in these trends are the bulk part of that trend, the green part of that trend, okay? As much as we possibly can, participate in these. And sometimes you get a lot of whipsaw activity where stocks are jumping around and you go, a whipsaw is basically where you get a new uptrend and then you immediately get a new downtrend. So we buy in here and we sell out here. And that creates stop outs. And if we get too many of those, then we're buying and selling over and over at the wrong possible time. Okay, now with momentum trading or trend trading, as we're focused on here, we're focusing on these kind of names like a Meta or a Google or a Tesla or a whatever the name is, whatever the company is, as long as they're continuing to move higher and they're increasing in share price and their earnings are also increasing, then we're going to see these really long periods of time that they continue to have these momentum trades or trends. Here's an example of some whipsaw where we get into the trade, it reverses, we stop out. Now, the reason why we want to stop out of a trade is to protect ourselves from losing more on that stock or trade. Again, 2020 hindsight's easy to look at that and say, I should have just held it, or I should have blah, blah, blah. Okay, it doesn't matter what the I shoulda, could have done because it's completely irrelevant. What did you do? And what are you going to do going forward? And so it's creating basically a range or a market structure so that you can say, I want to focus on these trends. The vast majority of uptrend, I'm not going to worry about the downside. I'm not going to try and short it or buy put options or whatever the case may be, at least not in a bull market as things are moving higher in an uptrend. We want to focus on quality companies that have nice ranks. Any rank above 80 for the most part is going to be moving higher. And then we're focused on staying in that trend as long as possible. And if that trend starts to shift, we're going to exit and get out of that until it presents itself again. It's going to happen. If it does happen and that trend presents itself again, we can get back in it. If it never does and it just all of a sudden becomes a dog and it continues to trend lower, obviously we will not have purchased back into that because it never gives us that uptrend again. Okay, that's just the real basic thesis. Now, the entry location, as far as where we're buying into these, is a little bit more disciplined in terms of looking for ideally we want a new entry. So if we were looking at Meta on this most recent trend, and we were seeing that pull back into, let's look at it back here. If we were to have run our scan, and that comes into the new buy scan right here, okay, remember that the new buy scan is pulling into, or any new buy scan is going from a hold to a buy, which means it's gone from one kind of non-trending market structure to a trending or momentum location. Okay, that is what we want to enter into. And we're okay with the fact that we're not buying here or here or here. We want really the stock to prove that all of this chop and mess right here is now out of the way. There's enough buyers in this trend. There's enough demand in this trend to push it past all of this crap. Okay, even this right here. Once the stock has proven that, now we want to play. Okay, we're not interested in being a part of that, trying to get that push higher. Let the institutions do that. That's what they do. That's why they're doing it, because they want to buy it at a very fair value. They want to buy it at a discount. So if they're buying into retracement or buying into dips, that's great. You can too, I suppose, as long as you're setting the same structure, the risk profile, and making sure that you're in those trades, or I should say out of those trades at a location that is preventing you from creating a small loser into a big loser. And that's why we're using stop loss. Now, let's say, for example, here on on Facebook, Meta, that we wanted to buy in at this price point right here. We go into our portfolio builder. We're looking for the number of shares. Okay, if I had this $117,000 portfolio, and let's remember, I've got to adjust this. So if I go to 5, let's call it 513. What's the high on that day? Actually, 518.30. So let's call this 518. So 518 number of shares. Okay, 10 shares put me at 4%. So it's such an expensive stock, I'm not going to be able to buy very many. And that's okay. Okay, if you buy 4 shares or 400 shares, it doesn't matter. 10% is 10%. Okay, and you don't need a small, inexpensive stock. You could buy 1 share at $500 and you're going to get the same performance if it goes up 100% as you would buying a $5 stock and it goes from 5 to 10. Okay, so just because it's an expensive stock relative to, my relative speaking is relative to a basket full of Costco groceries. Okay, $500 of Costco groceries, and I'm like, oh, okay, I get it. I get what that represents. That's a decent chunk. And so sometimes our minds, we place too much value of thinking this is expensive. It's not expensive. The market thinks that's what it's worth right now. And is it going to go higher? Is it going to go lower? That's the bet we have to take. And we're looking for different locations for that to happen. In this case, 518. Now I've got to decide where is my stop loss going to be? I know that my portfolio at risk, I could probably go a little bit higher than that. 5 shares might take us too high though. 2.21, really that acceptable range is between 2.25 and 2.5% portfolio allocation. Notice there's no stop loss here. So now I can say of my portfolio, I've got this amount at risk, 2.5%. Now let's go in and place a stop loss. You can place your stop loss in several locations. One of them is just to say, where is the most recent low of all the chop? If I were to go down to 454, and let's see what that looks like. 454 puts us at 0.27. Our acceptable risk range is typically 0.20 to 0.30. At least mine is for this portfolio that we're managing. It's relatively conservative. You might have a larger number right here. You may be up to 0.5 or even 1%, but in this case, this is inside of my acceptable risk level, and it's a deep enough stop to say there's a lot of support that could be happening right here to protect against that reversal, meaning everybody that bought, all these institutions that bought right here, if it trades back in, they're going to want to buy again. Okay, and so this area could act as a great support for stop losses. Now I've got my risk set up, $320, 12% retracement. If it retraces all the way to 454, I'm out. So I know that I'm out. I know what my risk looks like on the downside. Now on the upside, we don't know what that looks like. Okay, but we're going to anticipate that this is going to continue to move higher. Okay, until it doesn't. Until it stops moving higher. Now we use that 236 location as a trailing stop. So oftentimes if it gets to a certain area and we start to retrace, in this case we set our stop deeper so we know where we're at. Might have been too deep of a stop, but we want to give it plenty of room for some volatility. It did start to shift and start to change structure back to non-trending here in the yellow. Okay, that's non-trending or a transitionary phase of this yellow, transitioning from one trend or down, in this case, a downtrending structure to an uptrending structure, and the yellow is that in-between transition. So it gives us some time to say, what's happening here? Do we need to adjust our stop? Do we need to exit? Whatever the case may be here. So now we're seeing it continue to march higher. Get rid of this and see where we end up. We get the breakout. Okay, Now we're moving higher and higher and higher. Now we can start to adjust our stop loss. Okay, our initial stop loss was clear down here, 434. Our buy point was right here. We had a little retracement. Now we got some confirmation. Now we're in this trend. We can start to move our trailing stop with the trend higher as it's moving higher and just adjust it to this low point. This still is our playground. This is still the momentum location that we're okay with. And once that pulls back down, we run into the risk of starting to get into a shift of structure back into a trendless or a non-trending or a transitionary market structure from downtrend to uptrend. And that's kind of where we're at. That would be a process to go through with a new entry, market conditions. In this case, it was Meta. Where's my entry? Where's my stop loss? How am I managing that going forward? And then also we can be selling into some of that strength, a portion of the position. Okay, right now our trading plan is calling for at a 20% increase. If we're up 20%, we're going to sell 25% of the holdings. So if I have 100 shares, I'm going to sell 25 shares. It might be a little bit tougher with Meta, okay, but if I'm up 20%, I may be able to sell one of those shares into the strength. We want to sell into the strength as well as using a trailing stop on some of the shares so that we can try to get the best of both worlds. We're taking some money, taking some gains off the table into the strength, allowing for some volatility, allowing a trailing stop loss for the next move. If it happens, now we can say, oh, sweet, nice, that's great. We're still in that trade. And then it's not quite as an emotional problem, because one of the emotional issues we run into in trading stocks is that if we sell the entire position and it retraces back and then it marches higher, we're like, there's nothing worse than missing out on the thing you had right to begin with. So instead of selling all the shares into strength, at a certain target, sell a portion of the shares into that. This is a longer term portfolio management strategy where we're buying and selling multiple stocks and managing multiple stocks over the course of time. And instead of saying we're going to buy one stock today, sell it today, then tomorrow we'll do something different, we're still managing those stocks, and that takes days because these are daily bars and we're taking advantage of each of those daily bars. Okay, great place to start. So when we're talking about market conditions, that's why we do the videos each day, is to just refresh where are we at in this trend, what's our buy-sell ratio, because what that does is it helps us to determine what's our portfolio risk need to be. Do I want large position size, small position size, large stops, small stops? Which scan am I going to use? Am I going to use new buys? Okay, new buys are relatively aggressive because it's pulling in everything. And some of them are relatively thinly traded. It's only 100,000 shares or higher. So you do pull in some of the big ones, but you also pull in some of the super small cap names. And so those, because they're moving really aggressively, like this one, like AEYE, Audio Eye. It's only a $200 million market cap stock and trades, the average number of shares per day are in the, hundreds of thousands, if that, or lower. So it's a pretty thinly traded stock, which means it can gap around. It means it can move aggressively, but it can also, those shares can be sold really quickly by larger institutions. They could do, they can sell 50,000 shares in one fell swoop and just obliterate this stock. So the thinly traded stocks can be more aggressive. There's a little bit more reward to risk, but there is risk associated to those as well. So if you don't want that, then just set up your screener to have large cap uptrends. Okay, so here I've set the volume to be 250,000. I can go as high as I want. The higher the number of shares, the higher the volume I'm going to go, the smaller the output I'm going to get. There's still 55 stocks in that scan. Okay, so I can do that with market cap as well. So I can define really exactly what I'm looking for, but the entry and management process is still going to be the same. I'm looking for a stock, looking for it to transition. I either was stopped out or not, or I'm adding into something new, and I can do that. I want to be looking the vast majority of time in this upper momentum location. These corrective locations, this 382618, become corrective or counter trending locations, and you're dealing with this. Okay, this just takes time. It doesn't necessarily mean that it won't recover and you'll get your money back, but to ride from 100 down to 60, even on a company like this, it's an amazing company and stock, and you look at the last year or so on this, and it's just had a massive run up. But that was a pretty ugly retracement. It's a pretty ugly pullback. And so instead of riding it out and waiting for that, we can sell, stop out of it, and then just wait for the opportunity again to come back in. It gives us a little bit more control over the risk process. That's really what is our job, is to manage risk. We can't control what the stock's going to do, obviously, but we can and have to control the risk that we are entering into on each trade. I'm going to end on that note. Everyone, I appreciate your time and effort, and have a fantastic day today.